Welcome, everyone. It is great to have you here today with us. I want to start off with just a little bit of housekeeping. We will be recording today's session and we will share all of that, share that with all of you today. We've also, as you can see, got Gary and Benny on the line. They're here to answer any of your questions during the presentation. So please jump on the chat or the Q&A. Let us know if you have any questions. We'll also have some time at the end to answer any that we didn't get to throughout the presentation. So let's jump into the agenda for today. I'm going to start with talking a little bit about the purpose of target maps. What do we want to achieve with them? And then I'm going to work through a few different scenarios. And I'm going to illustrate frequently asked questions, so the questions we get from all of you. So the first one I'm going to look at is pre-retirement. So a family that's still working, working towards retirement, and what are the key things to think about in that scenario? Then we'll jump into in-retirement planning. So that's a client that's already retired. What are the differences and things we need to think about in that space? The third scenario I'm going to talk about is defined benefits, specifically Gdpf. We've received quite a few queries recently from planners with clients that are members of the Gdpf, or planners that have clients that are members of a fund that has defined benefits. And there's a couple of key things to think about when you're looking at that. And then the last scenario I'm going to look at is how you can use custom target maps to really show any goal or need that a client has, any cash flow. But I'm going to specifically look at how you model loans in target maps. And then stay tuned to the end, because we are going to give you a sneak peek of some new functionality that we're bringing in that I think you're all going to really love, and we're super excited to share that with you today. So let's get in. First thing I want to just touch on is what the purpose of target maps is, and it's really about enabling client conversations. So using asset maps' simple, rich design philosophy to illustrate to clients how funded they are across certain events or goals that they have. But most importantly, to facilitate a discussion around how we move them across this bar. How do we progress clients, and how do we help them take a step forward across the different goals and needs that they have? And as you know, there's a couple of templates in Asset Map, so we can look at loss of life, disability, if someone in the family has a long-term care event, what's the impact of that? We can look at education and retirement. But the last one is custom, and that gives us the ability to really model any goal or need that a client has, any cash flow modeling, and understand how on track they are, what they can do to move forward and progress, no matter what the goal is. Okay, so let's get started. I'm going to jump into the first scenario here. And here we have the Kensingtons. So we can see the Kensingtons, we've got Kate and Jessica. We can see they've got two children, Kyle and Jennifer. And they've, over time, they've accrued a lot of different financials. We've got retirement and discretionary investments. They've got risk benefits, property, loans. And what I want to talk through first is I just want to highlight some of the quality inputs that we can put in, or things to check when capturing an asset map, to make a more seamless conversation in target maps, and also to prevent having to jump back between asset map and target maps. So the first one I really want to highlight is if a client has any investments that they're contributing towards. So let's look at this example where they've got an employer retirement fund. We want to add the contributions in the details tab over here. And what makes it really seamless in target maps is if you put the end date in. So when are they planning to retire? You can, of course, put a start date in if you want to record that. But if you don't, it will assume it starts today. But important to put this end date in so that it's captured already when you move into target maps. And another key point, especially if it's an employer fund, is this annual contribution would be both the employees and the employer's contribution. So the total contribution that's going into this fund. Another key point I want to point out is in risk benefits. When it comes to disability, if you're capturing a capital disability, then it's important to put in the amount and the benefit interval as lump sum. So it's not an annual or monthly benefit, it's a lump sum that will be paid in year one. So this is important to put in, that it's years and that it's one, that benefit will pay out in year one should a client have a disability event. Similarly, for income disability or income protection, you want to capture that as monthly and put in when the benefit will end. So that would be 60, 65, 70. It really depends on that specific product, but key that you want to fill that in here so that it pulls through into target maps. Another key point you want to add in here is under the details tab, most income protection products increase by inflation each year. And you want to put that in under this COLA block here, this cost of living adjustment. So I've put in 6 to assume it increases by inflation. It's important to check on the product, does it increase? And if it does, to capture it in here so that it seamlessly pulls in to target maps. Okay, so that's some of the key things I want to point out in capturing, but let's jump across to target maps. I want to point out a couple of things here as well. So here we're looking at retirement for Kate and Jessica, and you'll see under what you want, I've put in here that this client wants 840,000 Rand a year for both of them, from 65 to 100, increasing by inflation. Also added in an annual amount for travel for a different time period. Okay, at 6%. But what I want to show you here is that you can add in additional items here by clicking on this add desired cash flow. But one thing that's coming up quite a bit is where clients need a staggered income. So maybe for this client, let's assume that they need 840,000, but only until age 85. And they believe after that, maybe they need 50,000 Rand a month. So then they'd be able to reduce it in today's terms. I could add that as a desired cash flow, but this new feature came in a few months ago where you could actually copy that line item. So in this case, I can click copy, it clones that line item, and I can then edit it. Say this one at 840 is going to stop at age 85. And I can say the second line item is going to start from age 85 till 100. So in here, I can change the amount and say, that time period, 50,000 a month will be enough. So I can call this, later life retirement income as an example, or whatever I would like to narrate it. So you can see here now, I've staggered it. I've said 840 until age 85 and thereafter 600,000. You can also rearrange these items. So now it turned out it ended up being in the order I wanted, but let's say I wanted to put travel right at the top. I can drag it and I can reorder so that it's a seamless and easy conversation to take the client through. Okay, so that's just some functionality in what you want to think about. When you go over to what you have, in this example, we're looking at retirement. So the first thing I want to point out is I'm not going to allocate the client's salary to this example because they're not saving their full salary towards retirement. So that's the first point I want to point out, is that we wouldn't select that. But I am including employer contributions. So this is their contributions to the employer funds. We can see Jessica is contributing 60,000 and Kate is contributing 90,000, dependent on their age till 65.
Yes.
A key thing I want to point out here. Sorry,
Can
Gary?
I pause you for a sec? Can you zoom in one magnification?
Perfect. Is that a bit better? Okay, perfect. Okay, great. So what I do want to point out here is that if a client is escalating their contributions, it's important to add that in here. The model will default to 0 because you want to be sure the client is committed to increasing it year on year in order to include that. But if they are, or if it's contributions that are going to increase with their salary by inflation, then you want to put that in over here. The other points I want to point out here, if we go to assets, so let me just scroll up, so better. In this case, I've included the 2 retirement funds, but now I can start selecting other funds that the client wants to allocate towards this goal. So in this scenario, I'm going to include the shares, but I'm not going to include the tax-free investments because perhaps there's a different purpose for those. So I'm not going to allocate that to the goal. What I want to point out here is that this client is now 94% funded. So they're quite on track for retirement, bit of a shortfall that we could look at. But if I hover over this bar, what this is showing me is how they are funded based on different sections. So we can see they're 77% funded based on the assets that they have today, and 16% of their funding is based on these cash flows. So that's an important conversation to have with the client, to say these contributions that you committed to making from now until retirement are so important because they represent 16% of how funded you are for retirement. Okay. And that becomes even more important when we talk about disability. So what I want to point out here in disability planning is that often we think of disability as protecting a client's income until retirement. So we normally look at income replacement or income protection or capital disability with the goal of protecting the client's income if they become disabled from now until retirement. And that's, you can see here, we've done here. But the key thing to think about when looking at that is then assuming that their retirement plan is okay. Because if they become disabled today and we protect them until retirement, then the retirement plan has to kick in and be able to fund from there. So one thing to consider in this client's example, we know that this client needs to contribute 90,000 per year. We saw how important that was in the retirement plan. We need to be able to ensure that in the event of disability, that this 420,000 can also cover both the income needs of the client as well as the 90,000 contributions to retirement. We could also add it as a desired cash flow to say, in addition to protecting your income, we also need to protect your retirement fund contributions. And that amount is 90,000 a year, increasing by inflation from now till 65. That way we know that in disability, we're protected for his income as well as his contributions to retirement, and that the retirement plan will not be impacted. So it's just a key thing to think about whenever you're looking at disability. Yeah. All right, I'm going to jump to the next scenario now. Next, we're going to be looking at in retirement. Okay, sorry, just one sec. There we go. So here we have Carrie. Carrie is retired already. You can see she's 68, and she's got a couple of things. Firstly, we can see she's got quite a few different income sources. We have a look here. We can see she's got a living annuity. So here's the asset, and she's drawing an income from that living annuity of 15,000 Rand per month. She's also got a life annuity and rental income. So we know the difference between a living annuity and life annuity. And therefore, for a living annuity, we want to capture the asset that the client has. They still have this value, as well as show the income that they're drawing from that investment. For a life annuity, the client no longer has the asset, so we don't capture the asset value, but we do capture the income that the client is receiving and guaranteed to receive from that annuity. And we can capture rental income here. In addition to that, this client also has a unit trust and a share portfolio. The client is currently earning 300,000 Rand a year, so 25,000 Rand a month. And that is a combination of 15,000 that she's drawing from the living annuity, as well as 5 from the life annuity and 5 from the rental income that she's receiving. But for this example, let's assume that she said, 25,000 a month is actually not enough. I want an income of 30,000 Rand per month. How sustainable is that income? So if we think about it, the real question that we're trying to unpack here is if these two incomes, if this life annuity is guaranteed and the client's receiving this rental income, and we assume that's steady, then the real question is, can this living annuity and perhaps also these additional investments fund 20,000 instead of 15,000? So how do we model that? So I'm going to jump over into target maps, and I'm going to create a new target map for Carrie for retirement. The first thing I'm going to do under what you want is I'm going to change that. So we know that what income she wants is actually 30,000 Rand a month. And that would be 360,000 Rand a year. We know that she wants to increase that by inflation each year so that she can keep up with inflation. And she'd like that from now, and let's say till age 100. We want to protect it until then. That's the need. The next step is to say, well, what can we allocate towards this goal? Now we know we can allocate that rental income. We can assume that she's going to receive that income steadily, from now till age 100, increasing by inflation. And we could also include the life annuity because we know that income is guaranteed. we would not include the living annuity income because that specific income is a drawing from an investment. It's not guaranteed. But what we would do is include the living annuity. And what we can see from this example is that based on just the living annuity and the additional income this client would like, she would like 30,000 a month. She's guaranteed 10,000 a month. So the rest would have to come from here. And we can see that she's 53% funded. So not quite enough from the living annuity alone. But now we can look at what if we included the unit trust and the share portfolio that this client has? How would that impact it? And we can see now she's 94% funded on the higher income if we use all of her investments. And we can take a look at this graph to see what does that mean tangibly for this client. So we can see that the income is going to start to be a problem in 2051. And in that year, we can see at the bottom here that she would be 97. So now we're in a good position to have that conversation with the client and say, if we were to increase it, it's looking okay till 97, but we would need to draw from your other investments as well. Okay.
So Kirst,
all right.
Can we pause for a sec there? We've got a question.
Sure.
Can you just,
sure.
can you explain the percentage of the living annuity? So Kenny's asking what percent, how does that translate into the percentage required from the living annuity?
From the living annuity. So 100%, that would be a calculation that you could look at to say, if we're drawing 20,000, in this case, we're not taking it from the living annuity alone. We're saying that this client needs 20,000 and there's a pot of funds that can facilitate that. That pot includes the living annuity as well as the share portfolio and the unit trust investments. And then there would be a separate implementation conversation. So, well, how much are we going to take from the living annuity? How much from the discretionary investments based on that client's unique circumstances? So this is really looking at a high level saying there's a pot of funds, there's an income required. Can we draw that income? Is that sustainable? Then there's another conversation, 100%. Okay.
Thanks.
All right. Gonna jump across into the next scenario. So the next one is Gdpf, and I've just taken an example of a Gdpf pension fund statement. And I know they can be a little bit different, and there's different rules if you've worked there for 10 years or haven't worked there for 10 years yet, or been a member of the fund. But just for the purposes of this example, I'm going to try and keep it quite simple. So typically there would be a resignation benefit. If the client left employment today, this is the value of the fund that they would take with them. And then there's normal retirement benefits. So if they were to remain at the Gdpf and retire from the Gdpf, there would be a monthly pension and usually a lump sum as well that would be paid. The same on ill health and the same for a potential death in service. So in this example, I'm just assuming these figures. So I'm saying, and please, the figures may not be exactly, accurate to scale in terms of ratios, but it's just to give you an example. Let's say the resignation benefit is 3 million and the client's contributing 60,000 a year. And then in all those events, whether it's retirement or ill health or death in service, there's an annuity payable as well as a lump sum of these amounts. But the first point I want to make here is that these income annuities that are payable, at retirement, all depends if the client remains a member of that fund. So when we look at these scenarios, I want to look at both scenarios. What if the client stays a member and retires with the client, with the fund? Or if they were to resign, what does their picture look like then? So I'm going to flip across to this example. Give me one sec. So let's have a look at this client. And I've put in the benefits that we just spoke about now. So I've said they're earning an income of this. This is the value of their resignation benefit, and I've added in the contribution here. I've put in the annuity. You can see that it's grayed out here, and that's because it's for a future date in time, so it's not available now. And you can see at the top that I've added different benefits that are available on death and in ill health, which is disability or a long-term care event. So when I go into target maps now, I want to create one where the client retires from the fund. And then I'll create a different scenario for the client's current retirement position. And that's just to illustrate the difference between remaining in the fund or leaving the fund. So if I open up the first one, here you'll see they're both the same in terms of the need the client has. So let's assume the client says they need 240,000 Rand a year from 65 to age 100, and they want that to keep up with inflation. In this example, I'm going to include the guaranteed benefits. So I'm going to say you're going to receive this annuity income from the fund. We can see they're already 100% funded just based on the numbers that I'm using. And I could also include any lump sum that they would receive at retirement as well. But in the other scenario, here I'm going to look slightly differently and say the need is the same, but let's assume that the client does not remain at the Gdpf, but does continue to contribute what they're currently contributing from now until 65. And of course, again, I can say that they would increase that over time, by inflation, and include their current resignation benefit. And you can see here in this example, the client is 66% funded. So I can show the client the difference between remaining or moving on, because then they would need to make different decisions around how much more they would need to save or contribute towards retirement. And this is just an example. The real figures might look a bit different, but I want to illustrate the concept of unpacking both scenarios for clients. And the same when it comes to loss of life. Here, because it's a defined benefit and the client will receive the income for life, I want to make sure that when I look at death and disability, that I also, under what you want, look at full life and not for a certain period of time, because you want to match the benefits the client's going to be receiving. So in other words, in this case, this income on death with the need that they have, and that would also be for life. And here again, I can add in the lump sum the client would receive and show the impact of that. Okay, so in this case, 89% funded in death. We may need to look at personal cover. So the key thing I want to illustrate in this example is just the understanding that the benefits apply if and when you stay with the company. If they leave, they need to be aware of what the impact of that is and how that will change their plan. Okay. All right, then let's go to the last example. So this one I've kept really simple, and really I wanted to illustrate custom target maps here, because a lot of clients ask us, clients have loans and they want to pay it off over different periods. What does that look like for the clients, and how do we illustrate that in target maps? So in this example, I've said this client is 60, they have a home, and they still have a bond on that home of 800,000 with an interest rate of 10% that will be paid off in 10 years. But let's say this client says, I'm 60 now, I want to retire at 65. How do I pay this off quicker so that I can get to retirement and have it paid off already? So in this example, I'm going to jump into target maps. I've created a custom target map, which then gives me the ability to call it whatever I want. And in this example, I've called it bond plan. The first thing we want to do is, under what you want, we want to add in the amount of the loan today. So I've said the loan amount, the current bond is 800,000, and the current bond is 800,000 as at today. So we don't put an end age in. It's a once-off need, they owe that today, and we don't put an escalation in. Okay. The next step I'm going to do is put in the interest rate here. So I've put in that this client has that loan at a 10% interest rate. And I've put in the duration of contributions we said is 10 years. So that's how long the client still has left on the bond. But now I can show different scenarios. I can say, well, what if you wanted to pay it off over 5 years? So watch this figure here. It's going to change to say, well, instead of 10,000 Rand a month, you would need to pay 16,857 Rand in order to pay this bond off in 5 years. And I can model any time period and show the impact of that. Okay. All right, I'm going to pause there. And any questions on those scenarios we want to go through?
I mean, there are quite a few comments, Kirsty, but I think everybody's blown away by trying to focus on both the conversation component as well as the calculation component. But maybe just a few points. Kenny made a great point. He said in your Gdpf example, remember that there might be a subsidy on the medical aid that the client,
Yes.
would forego when they resign, and that needs to be factored into the resign option. So I think that's a really good reminder for us.
Yes.
And then yeah, I think Philip mentioned, and Stefan as well, just on tax, and I think the loss to tax number, and I think leading into it, and I think there was a point that Kenny made as well. He was asking about the living annuity drawdown percentage, and I think that's the beauty of Asset Map, that as advisors we sort of think 3 steps ahead. So we already into the like the drawdown percentage and tax. We're going to get into that now, but and so what I really appreciate about Asset Map is that it reminds us, but hold on a sec, there's actually a whole separate conversation around, let's say, the what percentage do you take from the living annuity, what percentage do you take from the investments, and what are the implications thereof. In other words, Asset Map encourages us to split that out. And so maybe Kirsty, and we don't probably have time to go into the very detail of tax, but maybe just your thoughts on splitting out the conversation around tax, as opposed to just having it as a black box number that gets generated by the system.
I mean, I think the key thing with tax is that we're assuming that these are after-tax incomes. This is what the client would like in their pockets. And then under the what you have section, we're taking off this loss to taxes. And I know the question often comes in around retirement funds, because while we're in the retirement fund, it isn't being taxed, but yet we're applying 30%. And the reason for that is that we're looking at the lifetime of these funds. These funds will eventually go into a living annuity. They'll provide an income to the client. And we're saying over the lifetime, we don't know exactly what the tax is going to be from now till then, over the lifetime of these funds. But let's make an assumption that's realistic, that's reasonable, that we can apply to it. And let's make sure the client understands that. So the conversation here is to say, we know there's going to be tax over time. And because it's going to be income tax, it's going to be a bit higher than a discretionary where you're looking at interest, dividends, and capital gains tax. And therefore, let's assume that 30% is lost to taxes, and we can work with the 70% that's over. Yes, it may end up being 28 or 32, or how that happens over time, but at least we know we're taking a reasonable approach to tax, and we're saying that is lost. Let's work with what else we have and see because the real conversation is, if we assume it's 30% is lost and we can only work with the difference, what does that mean for you in terms of how funded you are? Because the big question is, do we need to do more? What is the steps we need to take to progress the client? And obviously over time, there might be times in the client's journey where we really need to delve into that in more detail. But the first question is just, how on track are we? And are there things that we can do now that give you a better chance of being successful at retirement? What are those things? And Asset Map is trying to focus the conversation on that. How do we move forward, and what are the things that we can do? Okay. All right, then I'm going to jump back to the presentation. And here we have the moments I hope you've all been waiting for, where we're going to share an exclusive sneak peek at some new functionality that's coming in. We wanted to share it with all of you first today. So coming soon in October, we'll be introducing target map templates. And that's going to give you the ability to create your own templates in target maps. So for example, here, you would have still the same options of loss of life, disability, retirement, custom, but there'll be an additional category called templates, where you can build your own house views into target maps. And you can stipulate, firstly, what do you want to call the target map by putting in the name, what you want to call each of the needs that the client has or wants that they have. You could also put in the amounts that you want them to be. And there is formulas that will show you quick and easy ones to say, I want it to be 90% of their current income, or 100% of their current income, or total liabilities. So in essence, you can create your exact templates that you want, and you can apply that to a client dynamically and see the impact. So here you can see I've applied this one. It's named what I called the template. Under these, you can see it's got all the wording I wanted to use, the amounts that I've calculated, the periods that I wanted it for with the escalations. And what's even great is if you create a target map for a client and you think, this one is really great, I'd love to use this for other clients, you can add it as a template, call it what you want, edit it as you need, and that template will then be available for the future. So you can build up as many of these templates as you like. And I think it's really exciting. I know a lot of you have been asking for that. I want the ability to put my own view on what that template should look like. So we're excited. This will be released in October, the first iteration. As always, we welcome your feedback as we refine it over time. But yeah, super, super excited for this enhancement.
Getting lots of whoops, Kirsty.
Okay,
Whoops
awesome.
and happy faces.
Whoops and happy faces. All right, then just to close off, so I just want to say thank you again for everyone for joining today. We are here to support you. So just a reminder, you've got the WhatsApp groups. You can ask us any questions you have anytime on there. There's also in-app support. And there's a support center that sits inside Asset Map. You can see that's where you find it by clicking on your initials or picture in the top right and selecting support documentation. There's lots of articles, webinars, videos on anything you can think of that's in Asset Map. So please, we're here to support you and let us know how we can.